Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our housing weekly market update. You won't believe what's going on. Okay, let me share my screen here with you. We have been seeing properties go under contract fairly quickly when we price them where they should be, when they're presenting properly, when they're marketing properly. We're still seeing quick offers, multiple offers on our product, our properties anecdotally. So let me jump in right here and let's take a look at what's going on in the news and all the housing stuff. So right now, top 10 areas people are moving to. Phoenix is number 2 on the list. And we have areas they're moving from: LA, New York, Washington, Seattle, San Francisco, Chicago, Hartford, Atlanta, Philadelphia, and Dallas, Texas. A lot of people moving here from LA and different areas of California for sure. Wholesale prices rose. This is important because inflation obviously is something that the Fed tracks along with job employment to set the Fed fund rate, which indirectly will affect mortgage rates. And of course, the bond market, the 10-year treasury, which we track because that will tell us where our mortgage rates are going to be and affect that. So wholesale prices rose 0.5% in March, much less than expected despite war impact. So the expectations from the Dow Jones census was 1.1%. It came in at 0.5. So excluding food and energy, core PPI was just up 0.1% against the forecast for 0.5%. So in other words, incredible news because this is the producer index. So this will be passed on to the consumer. So again, a lot of these price fixes that came in over the last 5, 6 years, those are there to stay as far as the levels, but some of the pricing we'll see go down. When this war is over, I'm going to tell you exactly what's going to happen. My sense is, within the next couple of months, this thing is going to be over. Gas prices will be back down around $60 a barrel. We've already seen them come down a little bit since the ceasefire. And now we see boats going through there. We see them come. We see like 100 oil ships coming to the Gulf of America, which is fantastic. That's good for us because we have the oil that they need. And people people in Europe, people even in China are going to need to come to us now. So that's good leverage to have, and that's good for our bottom line, for our economy, obviously. And we should see the prices come down at the pump once this all takes shape. So once that happens, we'll see the inflation rate go down on everything, which is a leading indicator here with the PPI, wholesale goods cost, and the producer price index. That's a leading indicator of where we are. So overall inflation, we should see come down, and we should see good news on the front from that. Now, the next Fed meeting, we're not going to expect any Fed rate cut or anything like that. But the following month, we're going to see that Kevin Warsh is supposed to be taking over for Jerome Powell. We'll see how that all happens. But this week, Scott Brissett was setting him up pretty well with, getting into that position. But this is great news. So we see the historical average. Again, I bring this up a lot of times, but historical average for U.S. inflation is 3.29%, going all the way back to 1914 to now. Notice 1914, what happened the year prior? Oh, we had, income tax come in and the Federal Reserve, right? Which has been a lot of the woes of our times. But anyway, that's for a whole nother talk. Long-term average 3.29, post World War II to today 3.5%. And they're always talking about this target, this number that comes out of New Zealand of 2% target, which I think it should be more of a range personally, and like a lot of economists have been talking about for quite a while, for where we should be trying to hit. I think that range should be somewhere between 2.3, 2.5 to 3.5, somewhere in there. I think we'll see things like that reconstructed with some forward-looking data. We know that the price of shelter's been coming down over the past 26, 27 months. And this is the inflation chart over the years going back to post World War II, so we can kind of see where we are today. Just very interesting that in the 1980s, inflation, of course, like many had to live through, was much higher than now. So a lot of people will say, well, but the prices were higher now, and a dollar went longer or went further, and all that. But all things being equal, you were actually paying more for everything back then, even with the dollar maybe stretching a little bit more. So, just something to think about with everything that's going on. Crude oil, it did get up to $111 a barrel. Now it's currently back down to about 93.583 per barrel. Of course, we want to get back to down to that 60 range, right? So we'll keep tracking that when this thing is over, or as the ships go through. There's been more and more ships going through. Once this thing is over, and realistically, yeah, they're maybe firing off a few drones and a couple missiles here and there, but realistically, without a Navy really to work with, or an Air Force, they don't really have much to go on. And I think the administration's being very nice in trying to negotiate and not just completely obliterating things. The people of Iran, who are under occupation really from the terror, I mean, they're calling for this. They've been calling for this. A great majority of them have been calling for this. So we'll see how it all plays out. Don't want to get too far into the political stuff, but obviously we're talking about economics, and some of this stuff it touches on the political. But there you go. Mentioned this last time, but U.S. payrolls rose by 178,000. Unemployment at 4.3 now. Unless that number rises over 250,000, alarm bells won't start going off unless we get to 323,000 on unemployment, more closer to a 5% range. We're not going to see much movement on the Fed to do anything there as far as the unemployment front, because they track their mandate is full employment and the inflation rate, keeping the inflation rate in line. So what we are seeing, payrolls are up this year. They are way up over the inflation rate. So that's a good sign for housing, because it's just, one of those things, you can gin up a lot of these different programs and government getting involved and this and that. And I think getting rid of some of the regulation, that's a great thing. Obviously bringing down energy prices, having a Fed that's, in the modern world and not antiquated and forward looking, rather than looking back, a year or two and running numbers and data off of that. That's all great. But in the end, it's going to take, some of this other stuff to really get us moving forward on and changing some of these models up. But looking at the weekly jobs claim fall 11,000 to 207,000. So usually when you see these numbers, you're dealing with a 4-week moving average. Okay, this is the weekly jobless claims fell 11,000 to 207,000. So all great stuff. And then when we look at the 10-year Treasury, U.S. Treasury yields rise after jobless claims data as Trump takes aim at Powell. So we had the rise in the Treasury, and then we've seen over the past few days that is actually stabilized a little bit over the last 3 months. We look at the last month, the last 5 days, it's stabilized a little bit. And in the last day, we had a little bit more volatility. So we look at that, we track that 10-year Treasury, because that 10-year Treasury historically is between 1.6 to 1.8, in between that range from the 30-year fixed rate of the 30-year fixed rate on conventional loans at 6.32 across the country. But if you want to look at what's going on here locally with our fantastic mortgage broker, Andrew Fisher with Semperfi Home Loans, yes, he is a Marine. He's a Marine reservist right now. But he has conventional at 5.5%, FHA at 5.12, BA the same, 5.125, 5.125, and Jumbo at 5.6. He also has ARMs right now, 5-year ARMs at 5% for conventional, 4.625 for FHA, and VA at 4.625. So that comes with shopping, 100 different lenders since he's a broker. It also comes with lower fee structures and savings for you. Pass that on. And also free appraisals for our buyers. So just something to keep in mind if you're thinking about making a purchase, whether you're selling and buying or just buying. Something to keep in mind because he does a fantastic job, gets everything done early so that you can close on time and makes the process really smooth for our clients and saves them a ton of money. So, for looking into a snapshot across the country, we'll get into the Phoenix area here in a minute on stats, but inventory growth is pretty flat, showing the inventory here. We can kind of see it kind of flattening out, still above last year's numbers. Right now, inventory growth is 3.21% higher than last year. We did get quite a bit more inventory last year, which was good because we needed it as a backstop to fill in. Um, just like we had Fannie Mae come along and purchase 200 billion in those mortgage-backed securities, that really helped to keep the spreads in line between the 10-year Treasury and the 30-year mortgage. Well, now we also have this extra inventory that came into play, gave us kind of a backstop there to more of normal pre-pandemic levels. Okay, at least at the lower range. And on that inventory, it kind of flattened out. Typically. Um, the new listings are below normal right now. We're looking at about 70,000 a week versus a typical of 80 to 100,000 is kind of normal historically. During the crash, we had 250 to 400,000 homes coming on the market every week, just to kind of give you a perspective there. During the peak of the crash here in the Phoenix area, we had like at any given time right around 56,000 homes for sale. Normally here we're going to be somewhere between 20 to 25, 26,000, right now. So just to kind of give you a perspective on some of those date ranges and data points, but our demand activity, um, for the new listings, in proportion with the supply and demand, we see the total pending sales. We're going up, and the pending sales slightly down versus last year. We started the year off pretty strong, and then the rates went up when we were hitting that. Once we get below the national average of about 6.25, we start to see that demand really bounce back. Once we head towards that 7 mark across the country, we see demand go low. Once we hit over 6.6, we see that demand go low. So right now, it's mixed week to week, better than last year overall, but inconsistent. Kind of a balanced, neutral market across the country. Not strong buyer, not really a strong seller as far as the whole country is concerned. Pricing behavior. We see 34% of homes reducing prices, which is in the normal range. No, signs of panic selling or major price drops. Typical right now is about 97% across the country and in the Phoenix area, list to sales price ratio. So sellers are giving up about right around 3% typically. In certain pockets of Phoenix, we see it even more, just depending on where you are. But it's very selective on areas that are more getting more demand, selling faster, those sorts of things. But right now we will kind of see what happens with this whole energy thing. We could get a second wave here in the mid to second part of the year, and going into the third quarter. We are still thinking that there's going to be not at the next meeting or anything, but we are still thinking by the end of the year we'll see 2 to 3 rate cuts, especially with the new Fed chair. We'll see a much more dovish tone coming from them, which really can have an effect on the 10-year Treasury and the bond market. which really, um, you know, gives it a big move, and they usually get ahead of the Fed, because it's, daily trading going on and stuff. But what the message is from the Fed makes up about 65 to 75% of where that 10-year treasury is going to be, okay, with the Fed rate, and but more so their messaging, okay. So we'll see how dovish Kevin Warsh will be once he gets in there. Um, the housing market's stable, but it's kind of boring, with that kind of neutral to balanced market. No crash, no boom. Inventory plus demand, basically equals closer to normal supply demand equilibrium. So real estate, can move slow. No, it's moving slow. No sudden shifts. But it's right now our spreads between the 10-year are a little bit higher than they were earlier this year at 2.0. Uh, we like to see that more towards the 1.8 to 1.7 range. So that's kind of where we are right now. But the mortgage application data, I want to show you here. If we go back into March to now, you can kind of see right after this conflict started, that's when this kind of dropped off, this mortgage application data. And that usually gives us a window into the next 30 to 90 days. People apply for a home loan. They need to get out there looking at properties, put in offers, get them accepted, get them closed out. Usual escrow period's about 30 days. Maybe they need to sell a house first, so it may be 2 to 4 weeks, depending on what market you're in and how you're pricing on that, that timing, and then could be even a couple months. And then, we kind of go from there. And then, somebody goes under contract, maybe contingent on the sale of their property. So that's why we say 30 to 90 days out. That kind of gives us a window. Right now, this has kind of dropped off a little bit though. So, and we could see again down here with the pending sales, it's definitely flattened out. Okay. For 26. Right now, we have pending sales at let's see, 378. So that's something that's kind of leveled off. It was going up and up and then kind of leveled off here. So we'll keep an eye on that. Again, all it takes is a dovish Fed and the end of this conflict. Oil prices come back down, everything gets back to normal and moving forward in a great way with the new Fed chair. So watch for inflation coming down, especially once these oil prices go down, and then watch for the dovish tone from the Fed and lower rates to come. All right. I think that's what we're going to see here in the next quarter or two. All right. So is inventory about to turn negative this year? Because we're only at 3.21 from the peak of last year. And that was, let's see, a peak of 33% because last year we got up near that 33% mark as mortgage rates move lower this week. So, hard year to year over comps and a lower 2026 rate curve have slowed inventory growth, with some markets already negative year over year. Mortgage spreads improved versus 2023 to 2025, keeping rates below 7 despite higher yields. Okay. So we've got lower rates. Things are kind of leveled off, a little bit of uncertainty. There's a little less inventory for people to choose from. That gives, a little bit more of a balanced market now. And we certainly aren't oversupplied. Again, we're right there at the low levels of the pre-pandemic levels on inventory. So that gives us a good idea of where things are right now. But, looking at the greater Phoenix area, we are at 74 days closed on market. Last week, we were actually at 81 days closed on market. So if nothing else came on for supply, we've got 74 day supply. We're at a 4.36 month supply, which tells us, we're kind of in a balanced supply market. Absorption rates 22.9 0.92, which last week we were at 29. Okay, so that's gone down a little bit. The average list price is 784. The average sales price is 630,000. The list to sales price ratio right there at that 97.32%. That's actually up a little bit from last week. We were at 97.23 last week. Actives, really, zero point 0.1 plus, not really much moving there. Pending is flat as far as what's going under contract, and closed units week over week, we're negative 1.9, which makes sense because about a month ago, this thing started. A little bit of volatility, higher rate, okay, a little bit of uncertainty for people. So that certainly makes sense that that would drop off a little bit and that these pending sales would be kind of flat. However, we do see, again, most of our inventory is up, from zero on up to 600,000 is 65.89% of the inventory, 600,000 to 1 million, 19.29%, and a million plus is 14.81%. Now, if, we, we were to look at the data, basically week over week, year over year, I should say, we've got about 200 more people going under contract than we did last year. This is week over week, but over last year, we're about 200 ahead. So there are a little bit more buyers out there looking. We definitely have lower rates than we did last year. They're just not as low as we were hoping for at this point in the process. But again, I think we're going to see those go down. All right. So this is as I mentioned before, this is the best week to have your home listed for sale. The week, according to Realtor.com, we have the week of April 12th through April 18th of 2026 is identified as the best time to sell. This could mean the national median list price is $5,300 higher than the yearly average and 26,000 higher than it was in January. So it does make a difference when you list. Just keep in mind there's going to be more people listed. Okay, that's why I always tell people you want to kind of get ahead of this time period. Same thing every year, and obviously certain areas of town, certain markets are going to be different depending on seasonal shifts, and winter visitors, all that kind of stuff. But that's why I always tell people get ahead of this a little bit and price accordingly, and make sure the property presents well. And we can certainly help you with all that to figure that out on, what it would look like to get the property ready for sale. A lot of times, people just, they don't even really understand, and they have questions about, not only what the property would list for, what the value is, but what it would cost to get the property sold. What are the timelines, all that kind of stuff. We'd be more than happy to meet with you to kind of go over all that. And if you find this information helpful, please make sure you hit that like button, share this with somebody who maybe would find this interesting information or helpful information. Also, be sure to follow us on here for these kind of updates and other, good information that will help you out there. Now, Cromford, our local gurus here, they not only plug in those numbers we showed you earlier in the greater Phoenix area, but they also use an algorithm kind of sense of what's going on in the market. They're saying it's a buyer's market. And from the standpoint of certain data points, I would agree. But it does depend a lot on what part of town you're in. It really does, and how well you prepare your home to present to the market. I always tell people too, it's not, it's your decision on where you want to price the home. All we can do is supply the comparables in your area, but it's your decision. However, the market is going to dictate really what the market will bear in order to purchase your home, what they're willing to pay for it. So, in any case, they're coming in, from 90 to 110 is a balanced range, 100 being totally balanced. We're at 83. That gives us a buyer's market according to Cromford. But again, a lot of this is going to be hyper local, which I'll show you in a minute. Now, supply is at 106, so we're 6 above that neutral point. On demand, we're down about 12 points on that. So, um, as far as being strictly at balance according to what they're showing. Um, on the contract ratios, this is holding pretty flat here at overall for the whole Maricopa County area. At a warm rate over 30, it's at 37.4. It's kind of giving again, a balanced market neutral range for buyers and sellers, not much of an advantage either way. But again, very important to understand it's going to depend a lot on your area. Okay. If we look on the heat map, Gilbert is in a very hot area. So is Tempe. We see Tolleson, this part of Phoenix at 85035, 85303 in Glendale is a hot area, 85302, 85306, and 85024. Everything else is pretty much in a warm area, except for this Scottsdale area right here and central Phoenix for the most part. And there's a couple little outliers here in Glendale. Um, Cave Creek, definitely in a cold market right now. So it takes the active and the under contract, and it gives you this ratio to tell you where we're at. And this is more of real time than even that other dial I showed you earlier. It tells us where we are right at the moment. A couple other things I wanted to share with you, just to kind of give you some anecdotal evidence. We listed this property. We did get a couple of offers. One was a low ball. We always get those. Another one was actually just over the list price when we came to terms. So, this, what we had under contract within 5 days. This was over in Canyon Trails in Goodyear. And then we also did the same thing over here. These are just a couple of our last properties that went under contract. At 350, that this property went under contract in a matter of 5 days also, just with some back and forth. But we had really an offer in hand in about 4 days. We actually had multiple offers on this one. This was in El Mirage in El Mirage area. So it's definitely a hot market if you price your property to get people through the door. And what I tell people is you want to be setting your property up in the way that these portals are set up, or the way, even more importantly, the way people search. People are searching by 25, 50, or $25,000 increments. We're not selling cans of soup, right? The old idea, oh, I'll price it for 199, a can of soup. Well, when people search online, if you set a property, for instance, like that last one, at let's say 349, and somebody's starting their search at 350, which people do like 350 to 400 or 350 to 450, they're going to miss that property entirely for the little quote unquote psychological way of positioning it. I want to position it better to look at the comparable sales. Yes. Look at the condition. How does it look? How does it present? How does it smell? All those sorts of things to a prospective buyer. Pretend like you were a buyer coming through the door. A lot of times it's also good even to get out there and look at the other properties that are active, which we're willing to do with our sellers. Look at the other properties that are active in your area or that went under contract, not only on paper, but in person. I'm happy to take you out and take a look at those in your area so that you can really get a sense of, what it looks like. Because a lot of times you look at a property online, you get there, it looks totally different. Maybe, they're not supposed to do that, but they Photoshop things in. We're allowed to do virtual staging, things like that. Certain things can be done like that, but sometimes you get there and it looks totally different than it did online. So it's super important to really have a sense of the market. That's what we try to do with our team, is make sure that we're out in the market, not only online, but out there looking at these properties in the areas that we're working, so that, for sellers and also even for buyers, because we can, if there's a neighborhood you really want to be in, we can kind of create the inventory. And what I mean by that is, Number one, there's always off-market properties, through our brokerage, that we have in our database. But also, we can reach out to people in those neighborhoods to see if maybe they're thinking about selling, and then we could find a place for you that way of something that you would have never known about in the first place. So it's just something to think about. Just one of many, 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 many strategies out there to help you find the right property or get you a sense on what your property is going to sell for, or what the best way to position it is. So if you have any questions at all about getting your home sold, what that would look like, the breakdown on what the cost would actually be in your area, because it is very specific. Even if you're in the same city, maybe even the same zip code, what that looks like in your community or your particular house and street versus a guy a couple of blocks over or in a different community. So we're more than happy to go over all that with you. If you'd like to start with a phone call, we can also meet you at your home or in our office to go over all the details. Obviously, if selling, it's great for us to see the house. I don't know an appraiser in the world that's going to give you an appraisal without looking at the property in person. So why would you, number one, why would you want us to do that without seeing the property? I totally get it if you want to talk first on the phone or whatever, or through Zoom. But our approach is also, new school, old school. Sometimes you got to cut through the noise, and you just have to do things that are directly to the buyers or sellers in the area with marketing, because there's so much noise online and stuff. Not that we don't do the social, not that we don't do the digital. Obviously, that's huge right now, even with AI now. People are searching for homes through AI. I just had somebody find me through Chat GPT today that wanted to buy properties. They're an investor. So, it's just something to be aware of, that you still want to take kind of a holistic approach, as well as knowing most likely what kind of buyer is going to be looking to buy your particular property, and what that's going to look like, what that offer is probably going to look like. Most likely, we can go through all that and help you figure out what you're going to have for walkaway money, okay, and how long it's going to take. So feel free to reach out anytime, guys. That's all I've got for you today. Thanks a lot. We'll talk to you next time.